Maya and Chris are both 35. Same city, same salary, same starting portfolio. It's a Tuesday evening in 2014, and both of them are staring at the same number on a screen, $100,000. Not inherited money, not lottery money, just years of saving, boring paycheck by boring paycheck. Maya feels nervous. She knows investing matters, but she doesn't want to mess it up, so she hires a polished financial advisor downtown. Glass office, leather chairs, a framed certificate on the wall. The advisor tells her, "We'll build a diversified portfolio and manage the risk." Chris feels nervous too, but instead of hiring the advisor, he spends a weekend reading about index funds, fees, and retirement accounts. He doesn't feel like an expert. He just sets up a simple, low-cost portfolio and tries not to touch it. Both save the same amount after that, $10,000 per year. Both invest for the same future, and both think they're doing the responsible thing. But 25 years later, one of them has hundreds of thousands of dollars more. So, what if your financial advisor is making you poorer? The part nobody explains clearly is this. A financial advisor does not need to be bad at their job to cost you a fortune. They can be friendly, smart, professional. They can send beautiful reports. They can calm you down during market crashes. They can remember your kids' names. And still, the math can quietly work against you, because in investing, small percentages are not small. A 1% advisory fee sounds harmless. 1 penny on the dollar, almost invisible. But that 1% is not charged once. It comes out every year. In good markets, bad markets, flat markets, whether your account goes up or down. Then there are fund expenses, sometimes trading costs, sometimes cash drag, sometimes commissions hidden inside the products being recommended. This is why the question is not, is my advisor a nice person? The question is, what am I paying, all in, and what am I getting in return? Because if the market gives you 7% per year before inflation and fees, and your total costs are 1.5%, you are not earning 7%. You are earning 5.5%. That gap sounds boring, but boring gaps are where fortunes disappear. Let's put Maya and Chris into the same 25-year experiment. They each start with $100,000 in 2014. They each add $10,000 at the end of every year. And let's assume the underlying investments return 7% per year before fees. Chris uses a basic index fund portfolio costing 0.05% per year. That's close to what some major broad market index funds have charged in recent years. Vanguard's total stock market ETF, for example, has had an expense ratio around 0.3%. Fidelity has offered zero-expense index funds since 2018. Low cost is no longer exotic, so Chris's net return is about 6.95%. Maya's advisor charges 1% of assets under management. Her funds average another 0.75% in expenses because they're actively managed mutual funds. Her all-in cost is 1.75%, so Maya's net return is 5.25%. Same contribution, same starting point, same market. After 25 years, Chris's portfolio grows to roughly $1.12 million. Maya's grows to roughly $861,000. The difference is about $259,000. Not because Chris found the next Apple, not because Maya panicked, not because one of them was smarter. It's mostly because a fee difference of 1.7 percentage points compounded for 25 years. And here's the uncomfortable part. Maya did not pay $259,000 in fees in the simple way people imagine. She paid fees, yes, but the bigger damage was the lost growth on the money that left her account. Every dollar paid in fees was a dollar that could not compound for the next decade or 2 decades. That is the hidden cost. Fees do not just subtract, they interrupt compounding. Now check in on them. Chris looks almost lazy. Maya looks more professionally managed. But the lazy-looking portfolio is quietly pulling ahead. Then comes the plot twist. In 2020, the market crashes. From February 19th to March 23rd, 2020, the S&P 500 falls about 34%. Headlines are terrifying. COVID shutdowns, unemployment spikes. The U.S. unemployment rate jumps from 3.5% in February 2020 to 14.8% in April, the highest level since the Great Depression era. Maya calls her advisor. This is the moment where a good advisor can actually earn their fee, not by picking magical stocks, by stopping a client from doing something disastrous. And to be fair, this is the strongest argument for paying for advice. Vanguard has estimated that good financial coaching, things like behavioral guidance, tax-smart withdrawal strategies, and proper asset allocation, can add around 3% in net value per year in certain situations. Not every year, not guaranteed, but potentially over time. Morningstar has made a similar point in its Gamma research. Advice can create value when it improves decisions, not just when it selects investments. So if Maya's advisor talks her out of selling everything in March 2020, that matters, because the recovery was fast. The S&P 500 hit its pandemic low on March 23, 2020, and by August 18, 2020, it had recovered to a new high. Anyone who sold near the bottom and waited for things to feel safe risked missing a huge rebound. But here's the twist. Maya's advisor does calm her down. Then he recommends moving part of her portfolio into a safer structured product and a higher cost income fund. It sounds reasonable, sophisticated even, but the new mix has higher costs, less transparency, and limits some upside. This is where the advisor problem gets murky. It is not always a cartoon villain charging into your account with a bag labeled fees. Sometimes it is incentives. For decades, many advisors were legally allowed to operate under a suitability standard, meaning a product had to be suitable for a client, not necessarily the best or lowest cost option. The fiduciary standard is stronger. It requires the advisor to put the client's interest first. That difference matters. A 2015 report from the White House Council of Economic Advisors estimated that conflicted investment advice cost Americans about $17 billion per year in retirement savings. That number was debated, but the core issue was real. When advisors are paid differently depending on what they sell, recommendations can tilt, and investors often cannot see the tilt. A mutual fund with a 5.75% front-end sales load, for example, takes $5,750 immediately from a $100,000 investment before the money even starts working. A fund with a 0.75% $12 billion one fee can quietly pay distribution costs year after year. An annuity surrender charge might start around 7% and decline over time. None of these automatically mean bad, but they do mean you need to understand who is getting paid, how much, and why. Maya assumes professional means optimized. Chris assumes simple means good enough. And in investing, good enough at low cost can be shockingly powerful. Then Chris does something counterintuitive. He pays for advice, but only once, and only for planning. In 2026, Chris realizes his life is more complicated. He has kids, a mortgage, stock compensation, aging parents, taxes that make his eyes glaze over. So he hires a fee-only planner for a flat project fee of $3,000, not to manage his portfolio forever, not to sell him a product, just to review his plan. The planner checks his insurance coverage, estate documents, retirement contribution strategy, asset allocation, and tax situation. She suggests he increase his emergency fund, adjust his beneficiary forms, sell one concentrated stock position gradually, and use tax loss harvesting when appropriate. Then Chris goes back to managing the simple portfolio himself. Maya, meanwhile, stays with the 1% advisor model because leaving feels awkward. She likes him. He has been there for years, and by now the fee is almost invisible. But 1% on $100,000 is $1,000. On $500,000, it is $5,000. On $1 million, it is $10,000 every year. That is the strange thing about asset-based fees. The bill rises as your wealth grows, even if the service does not become twice as hard. Now run the numbers again. Over 25 years, Maya ends near $861,000 under the higher fee path. Chris ends near $1.12 million, even after paying that one-time $3,000 planning fee. Round it down if you want. Assume Chris makes a few mistakes. Assume Maya's advisor adds some value during stressful markets. The gap can still be enormous. And this is not because advisors are useless. Some are incredibly valuable. A good advisor can help a widow avoid a predatory salesperson, help a high earner avoid a six-figure tax mistake, help a retiree decide which account to draw from first, help a panicked investor stay invested in 2008 when the S&P 500 fell about 57% from its 2007 peak to its 2009 low. That behavioral help can be worth a lot, but the advisor has to add value greater than the total cost. That is the whole game. If you are paying 1% per year on a $1 million portfolio, that is $10,000 this year. If the funds underneath cost another 0.6%, that is $6,000 more. All in, maybe $16,000 per year. Would you write a check for $16,000 if the fee were not quietly deducted from your account? Maybe yes, but you would probably ask better questions. What exactly are you doing for me this year? Are you a fiduciary 100% of the time? How are you paid? Do you receive commissions, referral fees, revenue sharing, or incentives from funds or insurance products? What is my all-in cost, including fund expenses? What benchmark should we compare against? How often do we change the plan, and why? Those questions do not make you rude, they make you awake. Because the danger is not having an advisor. The danger is outsourcing your financial life so completely that you stop reading the bill. So what would you do? Maybe you want full-service help because your situation is complex and you know you will make emotional decisions alone. That can be rational. Maybe you only need hourly or flat fee planning once in a while. Maybe you can handle a simple index portfolio and spend your energy on saving more, earning more, and avoiding panic. The point is not that every advisor makes you poorer. The point is that some advice is worth more than it costs, and some advice costs more than it is worth. Maya did the thing that looked responsible. Chris did the thing that looked too simple. But after 25 years, the difference was not confidence. It was cost, incentives, and clarity. So the real question is not, should I trust my financial advisor? It is sharper than that. If you added up every fee, every commission, every fund expense, and every hidden trade-off, would you still choose the same person, the same portfolio, and the same price? Because if the answer is no, your advisor may not be stealing from you. They may just be quietly making you poorer. A financial advisor can add real value, but only if the value is greater than the total cost of advice, products, and incentives working behind the scenes. So the question behind what if your financial advisor is making you poorer is simple. After all the fees are counted, are you getting guidance or just giving away your future returns? If you found this useful, subscribe to What If Finance. New video every week.